All right, well, welcome again to our session this morning on funding your small business, explore opportunities for growth. We're so happy that you could join us today. My name is Paula Whittekand. I'm the Network Training Manager for the Arizona SBDC, and I will be your host today. And joining me also is Esmeralda Estrada. She's our Program Coordinator at the State Office. She's going to be helping to keep an eye on Q&A and keeping us all on track this morning. So again, welcome to everyone. Before we get started, just a reminder to please enter any questions you have in the Q&A. And I think that's good. We'll go ahead and get started. All right, so it is National, at a time here, little delay. It is National Small Business Week, so we'd just like to congratulate all of the small business owners on our session today, and maybe those already in business or those considering starting a small business. This is a time when we celebrate all of you, not only across the nation, but here in Arizona. Now, just very briefly, before we get into the topic of the day, the Small Business Development Centers may be new to some of you. And basically we provide services, confidential one-to-one counseling at no fee for small businesses. Whether or not you're just have an idea and not quite sure how to get started, maybe you've started and you're kind of struggling to build that business, or maybe you're already in business and you're looking to expand, or just facing some challenges that you could use some assistance with. We serve all of those small businesses, again, at no fee, and in many of the areas you see on the screen here, but then also many more. And we are here to, help, economic impact in our state. So just quickly, you can see on the screen, just last year, we've helped almost 5,000 clients, advised 5,000 clients, helped business starts. Today, our topic, of course, is on funding. And last year, we helped $137 million in capital infusion for our small businesses and jobs created and sales increase. So if you've not yet met with an SBDC advisor, I invite you to check out our services. And we'll be sharing more information about that towards the end of the program this morning. Now, our funding journey today, right? It can be a challenge no matter where you are in that business stage of getting that funding and putting that plan in place. So today we are here, we've brought in a whole host of experts that I know you're going to appreciate what they bring and the knowledge and expertise they can share with you today. But we want to help you plan and successfully navigate and achieve that funding success. So where we're headed is 4 basic areas, really. We're going to talk about some critical funding readiness essentials, things that need to be done before you pull money out of the bank account or meet up with a lender or go to family and friends. We'll start there, and then we'll start to explore what some of those funding options are. There are many options out there today, so trying to get a handle on what's going to be the best for what your needs are. We'll help to give you an overview of what that looks like. And then from there, as you're getting closer to deciding on what that funding source is, there are some things you need to know about, how the lenders, whoever's giving you that money, how they're going to assess the risk and determine, are you eligible for what they have to offer? So we're going to touch on those areas. And then from there, we're going to finish off with our panel of lender experts, and you'll have a chance to really get some insights from all of them about, what this looks like from their perspective, and they can share their knowledge and expertise to help you prepare to get the funding that you need. So I hope you enjoy, and we've got a lot of information to share. Just a shout out to all of our guest speakers. Feel free to come off camera, everyone. We've got 4 of our colleagues from the SBDC Arizona Network here to share with you their expertise. We have Brian Quijada and Craig Jordan from the Arizona SBA District Office. And then we have 4 lender panelists, Karen Nelson from Community Investment Corporation, John Lewis from National Bank of Arizona, Gerald Tarling from Desert Financial Credit Union, and Uriel Arguelles from Lendistry. And with that, before we turn it over to our experts, we want to get a sense of, why you're joining us today. So if you could quickly answer the poll question, and I think this is going to help our speakers understand who's on the webinar, and so we can kind of make sure we're addressing some of the questions you have and know where you're at with funding for your business. All right. Just let it run here just another second or two. So it looks like we've got some that are planning to start a business, and you're probably exploring how am I going to fund it? Yep, that new start, right? You're needing some funding to maybe to support some growth. We have some established businesses. That's great. So maybe looking to sustain or grow. And yeah, maybe you're just interested in the general topic. That's wonderful. It's always great to learn more. There's so much to learn about being a business owner and how to grow a successful business. So, okay, I think we're good. Let's go ahead and get started. All right, I'm going to turn it over to Kevin Connors from the Central Arizona College SBDC. Welcome, Kevin.
Thanks, Paula. Good morning, everyone. Thank you for joining us today. My name is Kevin Connors. I'm the director for the Central Arizona College Small Business Development Center, and we serve all of Pinal County, Arizona. All right, let's get into this. So there are 4 big questions you need to ask yourself as you prepare for a round of funding. Excuse me, these steps are crucial in understanding what you need the money for and so on. So and by the way, it doesn't matter whether you're a startup or an existing business. These 4 questions to ask are across all different types of businesses, all different stages of business. So the first question to ask is, what is your funding goal? Defining your goal is it's certainly going to guide your funding decisions, and clearly define some boundaries too. So let's dig into this a little deeper. What is the reason for funding? Lots of them. We'll just have a few here. For instance, perhaps you need to purchase a commercial real estate, maybe a building, maybe some dirt to build on. Maybe you need that latest great piece of equipment to take your business to the next level. Maybe it's needing some money for marketing and advertising to drive sales. Perhaps maybe all you need is some kind of revolving line of credit to make sure that you can cover payroll and operational expenses. Maybe business is so good, it's time to expand and add that location. And sometimes it can be just simply for debt consolidation, but it's important to really define what's the reason behind you seeking the funding in the first place. And by the way, it's always going to be specific to your business and your industry. Very important to note that. So here are a couple examples of funding. So for instance, as a startup, let's say you want to open up a restaurant, you find that perfect space, but you need a lot of money to convert that into a restaurant for ovens and tables and everything else that go into creating a restaurant. Maybe what you're looking to do is add that panel truck to your plumbing business, for instance. Business is good. You need more people to help you do it. So you have to hire some employees. And that's going to take some working capital, perhaps, to make sure that you can cover payroll. For an existing business, perhaps it's time to move from that residential-based business into an office space. And maybe you need a little bit more room to accommodate more employees. We already mentioned perhaps purchasing vehicles to add to the fleet to grow the business. And as you do that, you may need more humans to help you. In addition to that, you might need some office equipment, some computers, and some software to do that. So here's some great examples, both from a startup and an existing business perspective. Take a sip. Here's the second question to ask yourself. How much money do I need? Lenders will want to know really down to the dollar what you're going to use this money for and how much you actually need. So it's important to go through this particular exercise. So what you simply do is develop a list of the things that you need to purchase or whatever you're going to do with that money. You create that detailed list to validate the funding amount. Excuse me. So if you, by the way, my allergies are killing me, so I apologize for my voice and my nose. On the right-hand side there, you see a listing. This is technically a use of funds that you would find in a business plan or a lending proposal. And we list there a vehicle at 45 grand. The forecast is you need 104,000 to be able to hire the new employees and cover their payroll until perhaps the business catches up with things. You want to purchase some computer equipment and maybe you need some office supplies. So in this particular situation, you see there that the funding need is $150,620. It's very important to be specific here and as detailed as possible. All right, I'm going to turn this over to Karen Eads now to handle the next two questions. Go ahead, Karen.
Hi, everyone. I'm Karen Eads. I'm with the Yavapai College Small Business Development Center, and we cover all of Yavapai County. So the third question you want to ask is, are your business financials accurate and up to date? Having up-to-date financials is really important. They tell you how your business is doing financially. I know as a small business owner, it is not always easy to stay on top of financials. Or you might be someone who knows the numbers, but just doesn't have them documented. Also, you might be someone who does not like numbers at all and has what we call number avoidance. This is where a bookkeeper or an accountant can be really helpful. Lenders are going to need to know the numbers, and they need to be accurate, and they need to be up to date. It is so important your financials are documented each month so you can review them. They tell you the health of your business, and we're going to dive deeper into the statements in 1 minute. I know it can feel overwhelming. If you need assistance, seek out help. Us at the SBDC centers can help you with that. Okay, so what financial information is needed? There are 3 financial statements that will give you the information the lender is looking for. Together, they will be used to determine your funding eligibility. There's the profit and loss statement, there's the cash flow statement, and the balance sheet. And we're going to go over each one of these in a little bit more detail. First, the profit and loss statement. This lists your revenue, expenses, and net income, and it's used by lenders to determine if you're making enough money to repay the debt that you're going to borrow. If you are a pre-venture business, you will need to have a projected profit and loss statement. And one thing about a projected profit and loss statement is it's really important to document your assumptions on how you came up with your projections, is they're going to tell the lender how you came up with the numbers that you're using in your projections. If you're an existing business, you will likely need 3 years of past statements to show performance. And each lender is going to have their own requirements. You may also be asked to do some projections going forward. And once again, it's going to be really important that you document your assumptions so you can explain them to the lender. So the next statement is the cash flow statement. And the cash flow statement tracks all of your inflows and outflows of cash in the business. It's an indicator to show your ability to make your loan payments. You know, one of the main reasons businesses go out of business is because they lack cash. So a cash flow statement is really important. And once again, pre-ventures will need forecasted projections, and assumptions are going to need to be documented. Existing businesses likely will need both current cash flow and projections. And as the business owner, you really have to know your numbers. Your bookkeeper or accountant may run them for you, but you must understand them and be able to answer questions about them. I believe it's a good practice to review your statements each month. And if you have a bookkeeper or an accountant, review the statements with them so you can really understand them. So the next statement we're going to talk about is the balance sheet. And the balance sheet really lists all of the company's assets, liabilities, and equity. Your assets and your liabilities equal equity, which is why it's called a balance sheet. Lenders look at this balance sheet to evaluate whether there are sufficient assets to cover both your current liabilities and to determine if you can repay the debt. It tells if the company has a strong foundation. Lenders look at the balance sheet to determine the level of risk to service the loan and evaluate collateral, such as buildings or equipment. Collateral is often needed to secure a loan, so they're going to look for that. And lastly, it can be used to compare your company with industry benchmarks to see where you stack up versus others in that industry. Okay, as a business owner, you have to be prepared to discuss your financials. It's really important that they're up to date and that you understand them and can discuss them with a lender. They're going to have questions and you're going to need to be able to answer those. All three of these statements, the profit and loss, the cash flow, and the balance sheet, should be used to inform business decisions. They tell you a lot about the health of your business. So even though we're talking about going for lending today, those business statements really should be looked at on a monthly basis because they're going to inform you how your business is doing. So the next thing that you're going to be asked for is a business plan. So do you have a business plan? A business plan is going to tell a lender all about your business, who you are, what you do, how you do it, and what your plans are for growth. Everyone, pre-venture and existing business, need a business plan. I believe they are important to have, even if you don't need financing. It's good to get all your ideas down on paper and have a plan. So is a business plan always needed? Yes. Whoops. Everybody should have a business plan. The components of a business plan will help you gain clarity about how and what you need to do in your business and help you make informed business decisions. The amount of detail needed in a business plan may vary by lender. A business plan consists of an executive summary, a narrative section, and a financial section. The narrative section tells about the business and includes a description of the company and its products and services, a market analysis, and information about the competition. It also includes information about the owners and the management team. So it's a little bit about everything in the business. And then it also includes a financial section. So, and part of the financial section is the use of funds section. And remember, Kevin talked about coming up with that list of how the funds will be used from the financing. This is where that goes in the business plan. The financial section also includes the projected financial statements that we spoke about earlier. Seeing some questions coming here. Let me see that. I'll get to that in a second. So as we go through the funding journey, there's 4 critical things that we've covered. First, you have to identify your funding goal. Why do you need the funding expansion? Is it marketing? Is it purchasing real estate, operations? Just be really clear on your goal. Second, you want to determine how much you need. Make a list of everything and total it up. And that's going to go in your plan. Third, you're going to make sure your business financials are accurate and up to date, and that if needed, develop forecasted financials that you understand and can speak to. Really important. And fourth and finally, develop a strong business plan. Explain what you do, how you do it, and show you have an understanding of the market and how you fit in. So I'm going to turn it over to George Kimball, and he's going to talk about funding options exploration. Thank you.
Hey, thank you, Karen. I'm George Kimball, a business analyst here with the Maricopa SBDC. My background has been in lending with a major local financial institution here in Phoenix area. And based upon what Kevin and Karen had mentioned, now we're ready. You got your financials, you got your business plan, and now we're ready to take the journey. Let's head into the lender area and let's see what lenders might want to look for. And again, back to what Karen and Kevin has said, what funding best matches your intended use and business stage? What type of funding do you really need? There's numerous types of funding that the bankers look for. Take a look at some terms. These are some technical terms that maybe a startup or a preventure or even existing customers, clients might want to take a look at. Equity injection, always an issue between the consumer and the lender. The consumer typically doesn't want to put much equity into the business loan, and however, the lender always wants more equity. Equity is based upon risk, based upon the type of the loan you're looking for, based upon collateral, based upon cash flow, the things that Karen and Kevin had talked about, the cash flow statements. How much equity do you want to inject? Typically, lenders look for a minimum of 20% down. Could be shorter depending on the creditworthiness of the client. I know Brian will talk about that in the SBA section, the 5 C's of credit. How strong is the entity based upon your cash flow, based upon risk, based upon the type of loan, it's going to be the equity portion. The loan term, what is the loan term? The loan term is a time for a loan to be paid off. Terms could be short term or long term, again, based upon the asset. Let's say you're buying a piece of property, real estate, a building. Generally, the loan term could be 20, 25 years. It could be a fixed rate, could be a variable, could be a combination of several. Some of our SBA products have a combination of short-term, long-term. And again, always ask the lender when you get into a term loan, what are the key elements of the prepayment penalty? A lot of clients that I've had in the past don't know what that is, but it's a prepayment penalty that the lender will assess with the loan. Typically, it's a 5, 4, 3, 2, 1 backwards, 5% for the first year, 4% for the second year, and 3%, 2%, 1%. So there's a prepayment penalty. So before you sign any loan documents with a lender, again, depending on what that risk is, make sure that you understand what that prepayment penalty might be. Rates. Rates are always another issue. Cost you pay to the lender for borrowing money to finance your loan on top of the loan amount or principal. Rates are generally based upon the Wall Street Journal prime rate. That rate today is 8.5%. All lenders most likely will add a factor to that rate, so they'll start at 8.5%. And based upon, again, the risk, the character, the amount of equity, the strength of the borrower, the strength of the cash flow situations, the strength of the financials, those loan rates factor could be maybe 2%, could be 3%. I've seen some with a minimum amount of capital injection, higher risk that the lender might ask, prime plus 4 or 5. Again, prime's at 8.5, so could be lending at 11, 12, 13%. That scares times the borrower, but that's the rates we're working with. Also, a factor with loan rates is your FICO score. Everyone has a FICO score. Lenders always look for a personal and a combination of a business. The small business scoring system called FICO is a combination of a personal business. And so they'll look at the combination of those, and the stronger the FICO score of the borrower, which again goes back to how much debt you have, how much capital you have, how strong is your entity. That FICO score usually on a business FICO, I believe, is around 1.5, maybe 160 is kind of a good combination rate. Collateral, always an issue, just like equity injection, always an issue. Seems like banks, lenders, credit unions, financial institutions will always ask for collateral. Very seldom have I seen loans that were unsecured. Sometimes there are. The borrower could be extremely strong, could be, a very strong balance sheet, very strong income statement, and it could be for a smaller short-term loan that the lender might feel that there is no collateral pledge. But generally speaking, the borrower has to be prepared based upon the asset value of the assets that they're pledging. We'll always have to pledge collateral for the loan. Funding sources, several of them: grants, self-funding, equity funding and crowdfunding, equity financing and crowdfunding, and debt financing. We'll jump into these a little briefly. Grants. Every small business that startup that I've dealt with thinks that grants will be the way to fund their business. It could be. Generally speaking, we don't find that there are many grants available for startups or even for venture businesses, even businesses who have been in business for less than 2 years. We call them startups. Financial institutions, the lenders will always ask for 2 years financial statements, 2-year cash flow statements, 2 years tax returns, and startups don't have that. So grants are very difficult to find. Not that they are impossible, but they are difficult. The federal government does not offer grants to individuals to start businesses or cover personal expenses. Sometimes a state agency, private or corporate organization, or nonprofit may offer grants with specific eligibility requirements. And beware of some of the government. These are scams, so be very careful. I would always contact if you're a client of the SBDC, please contact your advisor, and he or she could be able to help you with that also. Self-funding. This is an issue that is always very important. Always remember that raising capital is the foundation of every business entity. How are you going to raise money? The reality of many new small businesses is a need to use personal financial resources to support growth. Remember, lenders are cash flow lenders, and they want 2 years financials. They want 2 years tax returns, and you don't have that. So how do I self-fund? Well, one of the easy ways is if you are in business and you have your income statement and you have some income, you can draw from company revenue growth. That's one good way. Find ways to not need as much money as you initially thought. And Kevin talked about that when we looked at the statement of sources and uses. How much money do you actually need? Sometimes I've seen in the past that borrowers will come in and with a pie in the sky thought that I want all of this, but then when they start dialing down, they really don't need all that information or all that money that they need for the loan. So the lender will work through that to make sure that what you really need is what you're borrowing. Draw down from personal savings, maybe liquidation of investments. Leverage your personal assets, such as your home. Always a tough one. And not many borrowers I've seen in the past always want to have the bank, credit union, financial institution to put a second mortgage on your home. It's always an issue, but that sometimes happens. A lot of times you can have a HELOC, home equity, a line of credit. That might be an easy way if you're looking for self-funding. Could be refinancing for the home equity on your home. That's an easy way to do it. The rates could be less. The terms could be better. So always take a look at if you're looking for self-funding for your home equity line of credit. And of course, the big one, the other sources, I call it the bank of F&F, the bank of family and friends. Always your circle of influence that you need to look at. Always encourage your clients when they're looking at self-funding, whether you're a startup business or have been in business for a while, always make sure that the foundation of your entity is strong. Kevin and Karen both talked about cash flow and the strength of cash flow, and lenders will always look at that. Lenders are lenders are cash flow lenders, and they want to see that cash flow from the business. They want to see the strength of that entity, how strong, whether it's one member partnership, whether it's one member, 2 members, LLC. You always want to take a look at the strength of that foundation. We've found that very important going through the past COVID years of businesses who weren't strong cash flow. They didn't have enough cash flow to keep their business floating. And it's so important when businesses start up and get moving that they have that foundation and they have that cash flow. Okay, equity financing and crowdfunding. I'm just going through this real quick because this is something that is kind of a separate foundation and function that we deal in a different time frame. But private investors get funds in return for a share of ownership, equity financing. Venture capitalists, angel investors typically include resources, expertise, and networking. Networks you always look at this. Don't equity financing. Some financial organizations, when they look at equity financing, let's say it's an LLC, and you've got numerous members, typically anyone under a 20% guarantee or 20% interest would not have to guarantee the loan. The lender would use them for their cash flow analysis for the strength, but typically anybody with under 20% ownership on an LLC generally does not have the guarantee loan. So if you're looking at equity financing and you have Uncle Jimmy and Sally that's hesitant about signing documents, maybe keep them under 20%. That's just a general rule. Crowdfunding, funding a project or venture by raising money from a large number of people using online to get a one person, many people. Be careful on this because it requires thoughtful planning and execution to be very, very successful on that. Debt financing sources. Here's our lenders. Typical traditional banks, credit unions, online lenders, community development financials called CDFIs, which we use a lot in our business, or non-traditional lenders. Generally the online and community development, FDICs, and the non-traditional lenders, they're commonly known as non-bank lenders, but they have great products and they have great rates. So don't rule them out when you're looking at where do I need to go to get some financing. Debt financing. Here's some loans. Let's talk just real briefly on some of these with the business loan. Business loans are generally, it's a term loan. It provides for a lump sum of cash upfront, paid with interest on fixed monthly or monthly installments. We know about just like a car loan. You buy a car loan just for 5 years, you pay X amount each month. And again, the business loan, the terms can be different because of equipment financing. Perhaps could be 5 to 10 years. Real estate could be 20, 25 years. Most asset purchases like vehicles, equipment, those types of things in the business, 5 to 7 years is kind of a term. The business loan is generally, again, the term loan could be secured or unsecured. And again, ask your lender before you sign that loan document on any business loan what the prepayment penalty would be on that. Business loans, micro loans for startups. I think Brian will cover that a little bit with the SBA loans that they have. And business lines of credit. There's a couple of types of business lines of credit. So working capital revolving, that's generally like a large, I would look at it like a large credit card. Let's say, for example, I need to borrow some money to get some receivables, be paid, buy some inventory. And so I would do a line of credit for maybe $100,000. And the line of credit, it's usually a revolving rate. And so let's say I have $1,000 approved, $100,000 approved, and I need to borrow $20,000 to buy some inventory. So I draw down 20. I still have 80 sitting over in my pool. I now have 20. I buy my inventory. I make my product. I sell my product. I collect my receivables, and I pay that down. On a revolving line of credit, you're paying interest only. There's really no debt requirement. You just pay interest only. Now, it's like a large credit card, so to speak. So the sooner you pay that down, the quicker it goes back to your reserve. It's sort of like they call it working capital. So sometimes during that business cycle, your business cash flow cycle, which is generally January through December, not a fiscal year, but January through December, sometime during that cash flow cycle, lenders want to see that line of credit come to a zero balance. They call it resting. They don't want that principal balance to stay up there for a long period of time, because if they find that, it could be then they turn it into a term loan. But you want that working capital to revolve back and forth. You pay it off, you borrow, you pay it off, you borrow. But it's always there to use, and it's for working capital. It's helping you that business grow. As Kevin mentioned earlier, maybe you have to increase employees. Maybe you have to have some personal expenses in the business that you need that working capital. It's different than the working capital term. So working capital term is like a revolving credit, but let's say I'm a business and I'm manufacturing and I need 4 pieces of equipment, but I don't need them all right now. So I get a working capital line for $200,000, for example, and I buy my first piece of equipment, but I don't need other pieces until 4 or 5 months later. So I have the first loan for that one piece of equipment. And then as you buy more pieces of equipment, that working capital term goes down to 0. And once it reaches 0, it's gone. It's not like a working capital revolving. It doesn't revolve back and forth. Once it reaches zero, it's at that minimum. SBA guaranteed loans, again, Brian will cover those. Micro business loans, business credit cards, usually very good for some startup businesses. I encourage businesses to, if they're starting up with new business, to get your business loan, a business bank account set up, either a credit union, financial institution, bank, wherever. But always ask the lender for a startup, a business credit card. Maybe it's only 1,000, 2,000, whatever, but get something that you're using for your business expenses, because it's important to keep your business expenses and personal expenses separate. I know that's very difficult for startups, but you want to make sure that your accounting system is set up so that your business receipts and disbursements are being recorded properly and your personal is recorded differently. But until that business starts creating income, then you really have to continue to use your personal. But once that business entity reaches a significant level that it can pay its expenses, make sure that your personal credit cards and personal expenses are not being put into the business. And with that, I'm going to turn it over to one of our SBA experts, Brian. It is all yours, my friend.
Thank you, George. Good morning, all, and thank you for joining us today. My name is Brian Quijada. I am a lender relations specialist with SBA's Arizona District Office. I will be covering SBA's loan programs and the credit factors lenders utilize to determine eligibility for a loan. As you have learned in today's presentations, there are various options for debt financing, and SBA loans are one of them. They're very common for both. They're common for both startups and existing businesses. An SBA loan is a typical commercial loan with an SBA guarantee. The guarantee functions like an insurance policy, ranging between 50 to 90%. The guarantee helps banks mitigate their risk, allowing the bank to consider a loan for a business they would normally decline. The guarantee allows lenders to offer better credit terms, such as long, fully amortized loans with no balloon payments. Also, it allows to have interest rates capped by law, and most typical commercial loan fees are prohibited. In general, for every $1 we guarantee in Arizona, about 30 cents goes to a new small business. We're able to stipulate certain legislative benefits because of the guarantee. Here we have a general overview of our loan programs. The 7A loan includes express products and lines of credit, and also special purpose loans such as export, IT, energy conservation, and employee stock ownership program. This is our most popular loan program. Loans are available up to $5 million. The funds can be used for most business purposes. This is ideal for either a startup or an existing business, and it also offers term flexibility. Next, we have microloans. They are offered through a nonprofit or a non-bank lender. Loans are available up to $50,000, but most are found in the $3,000 to $7,000 range. There is no SBA guarantee on microloans. The lender sets the credit and collateral standards. Technical assistance training is usually required for a microloan. A microloan is a great source for small startups, anyone with less than perfect credit, or with little to no collateral. And finally, we have the 504 loan program. This is designed for long-term commercial real estate or large fixed asset projects. They are offered by nonprofit certified development companies, or otherwise known as CDCs. Most loans are 25 years with fixed rates. The projects are structured with 3 parties involved. Number one, you have a third-party traditional commercial bank. They finance 50% of the project. The 504, the certified development lender, covers 40% of the project, with the borrower coming in with the remaining 10% from their own funds. However, some transactions may require more than 10% from the borrower, but this is the typical setup for a 504 loan. Now, you may qualify for either a 7(a) or 504. So when you're shopping for a loan product, please consider both terms and fees to determine which would be the better product for you. Now, general eligibility for SBA loans include meeting the size standards for small businesses, the type of business or industry, your loan purpose. It's important to know how you're going to be using your loan funds and have that plan detailed for your lender. Be a for-profit entity, and you must meet the lender's credit requirements as well. Loan maturities will depend on the useful life of the asset being financed, along with the borrower's ability to repay. And this slide here provides you the maximums that we're typically working with. So for financing working capital, your maturities are expected to be between 7 to 10 years. Equipment, between 10 to 25 years. Real estate or business acquisition, that could be up to 25 years. But remember, all SBA loans are fully amortized, so you will not have a balloon payment at the end of your term. Interest rates on SBA loans may be fixed or variable. Variable rates are negotiated with your lender, and they are capped at 3% over the prime rate. Prime rate, as George mentioned earlier, currently is at 8.5%. Fixed rates are capped by a ceiling that is published monthly. Your lender will ensure it does not exceed the cap. The current fixed rate for loans are prime plus 2 to 3%, determined on the risk and the size of the loan, and it is also negotiated with your lender. Now, there are two types of fees involved with an SBA loan. First, you have your SBA fees. This is the guarantee fee, and it can be included in your loan. The fee ranges between 2 to 3.75% of the guaranteed portion of the loan. Currently, loans less than $1 million, the fee is waived through September 30th, 2024. Prepayment penalties are applicable to longer-term loans. The second set of fees are your lender fees. First, origination, commitment, bonus, broker, commission, or referral fees are not allowed. Servicing, packaging, and late payment fees are allowed from the lender side. We're moving on now to cover the credit factors that a lender will review to determine eligibility for your loan. A lender applies various credit factors to determine if you can repay a loan. It's very important for you to know what those credit factors are and how they're measured to help you think like a lender and best prepare yourself. These factors include your credit history, your equity investment, repayment ability. With regards to repayment ability, think of experiences you've had in obtaining a car loan or a mortgage. Working capital, collateral, and management ability. These factors are used to determine if and how much you will be eligible for. The first factor is credit and scoring, and it refers to your credit and repayment history. First and foremost, SBA does not have a minimum credit score requirement. That the credit score requirement is determined by your lender. An algorithm decides if you're creditworthy based on your credit history. This is used by lenders in consumer and mortgage industries. The average credit score is 680, and the chart on your screen there provides a general idea what your credit score range is. As you can see, 760 and above is considered A+ credit, while below 620 is considered poor. Now, if you are below 620, it can be challenging to obtain lending, but a lender may consider you if you can demonstrate strong compensating factors, letters of explanation, or documentation to support your request. You can pull a free credit report annually at annualcreditreport.com to review your credit history. If there are negative or erroneous items on your credit file, you can file disputes or work with your creditors to reconcile bad debts or remove any erroneous items. Okay, moving on now to equity investment. This is also your down payment or contribution to your business. The lender determines how much injection it needs from you based on your credit profile, and this could be up to 50%. In the example provided, we have a business seeking a $300,000 loan and two different lending scenarios based on their credit profile. The borrower on the left is a low-risk candidate and with the lender requiring 30% down, whereas the bar on the right is high risk requiring 50%. As you can see, there's a big difference in the amount of the loan and also the personal contribution, the cash contribution that you have to contribute to obtain this financing there. Next is loan repayment, and this is by far the most important credit factor. Think to an experience of obtaining a car loan or a mortgage and determining your price point to reach a comfortable mortgage payment. All SBA lenders are cash flow lenders, and they do not lend on collateral alone. To calculate your loan repayment, a lender must first determine the operating cash flow of a business. And this can be found on the income statement, and it's defined as earnings before interest, taxes, depreciation, and amortization. That'll provide you your business cash flow. And two measures of cash flow are calculated by the lenders. The first one is known as the debt service coverage ratio. And this takes your business cash flows divided by your business debts. The minimum ratio that you must meet is a 1.15 to 1. So what does that mean? That means that for every dollar in debt, you must have $1.15 in cash flow to repay. So 1.15 is the SBA minimum requirement, where the industry standard is 1.25. I did mention there was two measures. The second is known as the cash flow coverage ratio, and that is essentially the same formula, but you are now comprising any personal or external income that you may have. So if you have your business a job in addition to your business, you include that income along with business and personal debts. The cash flow, the global ratio must equal to or be greater than 1 to 1. So $1 coming in, $1 going out. Next, we have working capital. This is defined as current assets minus current liabilities. This is a critical test performed by lenders, and it's a calculation taken from the balance sheet. Lenders compare your working capital to the industry standard. This determines how much capital you need to meet payroll, purchase inventory, or pay off creditors, especially if you're having trouble collecting on invoices. Lenders use traditional business assets and personal guarantees to protect their loans against potential loss. It's common for the lender to place a blanket lien on existing and future assets. Available assets strengthen your credit profile. Now, all collateral is appraised at your liquidation value. That means your garage sale value, and you must maintain it insured. In today's economy, lenders may require additional collateral, such as your personal residence. Then there are instances where you may be able to utilize outside collateral or an external guarantor. So if you have a rich uncle that can pledge an asset for this transaction, that can be done, but it's a conversation to have with your lender. This chart provides a list of typical assets a business may own and about what their garage sale value is. So for example, taking on the first line item, the fair market value of an asset, such as a personal residence, you discount it to 75, 80%, and that arrives you at the approximate liquidation value. Finally, management ability. Poor management is the #1 reason small businesses fail. You must demonstrate your ability through your resume or through past management experience. Outside training can help mitigate those without sufficient experience. And this concludes my portion of the presentation covering SBA's loan programs and credit factors. At this point, I will turn it over to Nancy Sanders. Thank you again, and please reach out with any questions.
Thanks, Brian. Could I have my lender panel unmute, or I'm sorry, come on camera and be prepared to unmute. So this is a lot of information, and I've been monitoring some of the Q&A and chat, and so we've got a lot of great questions, and some of our experts have already answered or are already answering some of those questions. So we thought it would be a good idea to put together a group of lenders and lending resources to share kind of the nuts and bolts, the way it really is in the real world. So it's not just us telling you how it is, but they're going to tell you how it is too. So we have, and so I'm going to have you briefly introduce yourself and maybe a sentence or two about your organization and what your niche is. And so I'm going to start with the way you appear to me, which is Caroline, and then John. Caroline.
Good morning. Caroline Nelson. I'm with Community Investment Corporation. We are a nonprofit lender located in Tucson, and we serve the entire southern Arizona region. We work with businesses who are not yet able to access traditional capital. So typically before you're able to get a bank loan, that's when we would work with you.
Good morning. My name is John Lewis with National Bank of Arizona. I oversee business banking throughout the state. Our sweet spot is we work with a lot of small to medium-sized businesses and also up to the middle market-sized businesses. We're a preferred SBA lender and very involved in SBA lending also.
Thank you, John. Gerald, and then Uriel.
Yeah, good morning. My name is Gerald Tarling with Desert Financial Credit Union. I'm their business development officer, and I would say our sweet spot is businesses that are somewhere in like the year-old range. We can do some traditional, we can do some SBA. We just we kind of step in when something's not quite right with a traditional loan. So.
Hi everyone, my name is Uriel. I'm with Lendistry, and I'm the VP Relationship Manager. Lendistry is a national CDFI, so we cover almost all 50 states. Cover all of Arizona through our SBA programs, conventional, and we also offer SSBCI financing. Typically, we work with you as a borrower when you reach the point where you're trying to scale, but not quite there yet because a lot of the traditional financing is not available. And so that's where we come in. Typically, our business clients have 2 years or more in business and are seeking for capital anywhere between $25,000 and $5 million. Thank you.
Thanks, Uriel. Craig?
Hi, I'm Craig Jordan. I'm with the Small Business Administration, and we focus on eligible businesses and provide a suite of loan products, but basically our largest loan product is $0 to $5 million, and I work specifically with the lenders that participate in the loan program so that they can keep that guarantee, as Brian had mentioned, the 50 to 90% guarantee. They can keep that guarantee throughout the life of the loan.
Thank you, Craig. So again, the purpose of this panel discussion is to give you information about what's a good fit for you as a prospective borrower. So the first question is to give us one general recommendation you would suggest to business owners to find a good lender, or what small business is a good fit for your products and services. And so this time we're going to start in reverse order. We'll start with you, Uriel, and go to Gerald.
Thank you. Uriel with Lendistry again. So typically, I would say you should ask your lenders a few questions, maybe 3. One is, what are your FICO requirements? 2, what stages of companies do you work with? Are they startups? Are they existing businesses? And also, what loans amounts do you do? And to answer the other question, we typically require 2 years in business. Our FICO scores are above 650. And our minimum loan amount is $25,000.
Thanks, Uriel. Gerald.
All right, yeah, to kind of tag on to Uriel, those are same questions. I think we all agree that are fantastic. One thing when I'm working with business owners that I really try to establish is a personality match as well. Are you able to have a conversation with your lender? You need somebody that's going to understand where you're coming from. And so being able to relate what you're saying to what the bank is trying to ask is an essential step. For businesses that are a good match for us, we really look at the business owner, their experience with what they're doing. Put a little bit more weight on that than the actual business itself. So like if you were, for example, a roofer and you were managing roofing companies for 20 years and when started your own business, we're not going to just say, oh, you're brand new. Well, you've got 20 plus years doing this. That's worth something. So let's try to, get the bank and the business owner to meet in the middle on something that's workable. We don't typically do like minimums and maximums. We look at traditional cash flow and what kind of payments can be supported. So as was said earlier, keeping your documentation clean so you can explain to us how you make your money is an essential step. So,
Gerald. John.
One of the things I do believe that's important, going back to what Gerald said about having a good match, but also understanding that the lender you're working with understands your market, understands your industry. I think that's so crucial to be able to talk to somebody that understands where you're coming from and can help you walk through the process. And so that's something I really encourage, that if you can find a match where it's somewhere within the same community you're at, I think that does help to understand the same areas and the same industries that you're serving. As far as a good match for us, we service all types of businesses throughout the state, from established businesses to startup businesses. And so wide range of products available. As far as the loan size, our minimum loan size is $10,000. And then we can go up from there to large amounts.
Thank you, John. Caroline.
So I echo everything that everyone has said. When I work with businesses, my first question to them, or one of my first questions, is always, have you talked to your bank? Banks are typically relational based, and so it's helpful to talk to your bank, see if they would, if they're able to make you a loan, and then also just interview a couple different lenders. We all offer similar products, and so also finding that lender fit, who you're comfortable working with. We're likely going to dive into the nitty-gritty details of your business, and so you also want to make sure that you're comfortable working with that individual. As far as a good fit for our services, so as I mentioned earlier, we typically work with businesses who are not yet ready for bank financing, and that could be because they need a smaller loan amount than the banks are able to lend, or they're just newer in business. So for us, ideally, we're looking for someone with some sales history, ideally 6 months of history. Definitely, you should be keeping track of your finances. We make loans up to $100,000, and in our market, we really have a niche for what we consider microloans, so around the $10,000 range. So good fit, maybe this is your first loan, or you've not gone through this process before and you're looking for someone to really walk through it with you, we would be a great resource.
Thank you, Caroline. Craig, is there anything you'd like to add?
Well, I suppose just in addition to that, there are a couple of things that I would recommend. Some things that we talk about in the loan clinic are, I would say, start with your depository relationship if you have one, and if you have a business relationship. And then beyond that, there's really two ways. One is you could reach out to us and we will provide you with our local lender list, which has some preferences on there that you've heard the lenders talk about. Do they lend to startups? What is their minimum loan size? Things of that nature. So that's one way. The other way is they can utilize our match tool, which is called Lender Match on SBA.gov. And basically what that allows you to do is to go on there, create a profile, tell it what you're looking for. It's going to ask you questions about your business and what it is that you're trying to do. And then it's going to attempt to match you with lenders that have signed up to take leads from that program. So when you get matched, you're actually going to be specifically matched to SBA lenders that are interested in talking to you deeper about your project. And that's usually what I recommend borrowers do. Whenever you ask the district office or anyone at SBA, we're required to not show preference. So we have to give you the names of at least 3 lenders that are possibilities. And many times, like with the lender list, you'll get many, many more. And you just have to kind of figure out, like you said, using those pieces of advice from the other lenders, which questions you want to ask and how comfortable you want to feel to find the right match.
Thank you, Craig. So you've gotten an idea about what's a good fit, a good lender fit for what you might need. And I think that the first question is not just the first question that everyone has, right, is how long does it take, right? But that's really dependent, of course, on the process and what documentation is needed. And so let's start with you, John, to give us some insight into your institution and what the time frame is.
Very good. A lot of this has to do with what type of product you're seeking as far as the length of time and what is required. So just a few things. At National Bank of Arizona, we do have an application-only product for lines of credit up to $100,000 and secured loans up to $250,000, which is purely just an application that can be completed, underwritten, documented within 48 hours. And so there is an opportunity for application only. For a small business, a startup business, we also have a streamlined SBA 7A product up to $150,000 that requires only an application, a business plan, and bank statements. It doesn't require tax returns or financial statements, which we turn around those pretty quick also. As you get farther beyond that, you will start needing to provide tax returns, personal and business financial statements, personal financial statements. And then depending on what your collateral is, if you start talking about real estate, you're doing a real estate purchase, that process might end up taking a 60-day turn time to get that done. So 60 to 90 days, depending on what happens throughout the process. Now, I would just say one thing: the communication with your lender throughout the process is key to the speed. The quicker you communicate back with your lender, the quicker they're going to be able to get it through the process.
Thanks, John. Let's hear from you, Caroline, and then Uriel.
Yeah, so we have a number of different loan products. Maybe backtrack. So my first question when I'm talking to someone is really, how much money do you need? What do you need it for? And I'm going to ask a lot of questions just to understand where you are financially, what assets you have to offer as collateral, what your overall plan is so we can find the right fit for you. As John mentioned, the documentation you have available is important, and that speeds up the process. So we can typically, we could realistically turn a loan around in maybe 3 or 4 weeks if someone is really buttoned up. In the space that I work in, though, it usually takes a couple of months, just because a lot of times I'm seeing businesses don't have all their documents together. Maybe they haven't been keeping track of financials in the way that's needed. And so we will work with you to get through that process. But, from an expectation setting perspective, typically, 1 to 3 months is probably normal.
Thank you, Caroline.
Thank you. And at Lendistry, so we're a fintech-enabled CDFI, and typically all of our applications are done online. The typical application takes about 15 minutes to complete. What we require is the last 3 years of business tax returns, a business license, and a photo ID. Typically, for loans that are over 500,000, I would say it's taking maybe about 21 days. For loans under 500,000, it's taking about 12 days to fund. And there are some loans that are under 150,000. So those loans ranging from 25,000 to up to 150, who have a scored process, and we can fund them as quickly as 5 days. So I would say that's kind of the application process. It is an online process, and aside from the fact that it is online, the other thing you can expect is that you're going to get a call or an email from one of our representatives to help you through the process. And if you're stuck in the application, you can always call us and we can walk you through the application virtually or over the phone.
Thanks, Uriel. Gerald.
Yeah, so I mean, to kind of echo what's been said, yeah, the application, the product's going to really dictate the time. Your unsecured products, depending on dollar amount, a couple days, to your heavier commercial real estate properties, a couple months, again, depending on appraisals, vendor work, things like that. But articulating exactly what you're looking for in the beginning is essential. So we first off apply for the right product. That's going to make a huge impact on your amount of time. As far as your documentation, depending on the product, maybe none. If you're doing like a full commercial deal, everything you have. We are going to really look at 2 to 3 years financial packages for secured real estate type transactions. Unsecured, it's unsecured, so there's not a lot to consider, so it's quicker. But yeah, just really working with your lender through the process, making sure you're applying for the right product. You're gonna, we move as quick as you do. The more prepared you are, the more prepared we are to answer the questions the underwriter is going to ask. So that's what I'd say to that.
Thanks, Gerald. And Craig. I always call on you last because I feel like, you've got the broader perspective. So that's why I'm singling you out.
Yeah, most people don't understand how it works. And I guess most people would have a question of, if you don't take the direct application, how does it work? Does it add a whole bunch of time? And so the answer to that is it kind of depends on the lender that you're working with. If your lender has a preferred status and they're going to process it that way, they very likely get an approval within 24 hours. We do some background checks and things of that nature. If there's no glitch there and they're using their delegated authority or their preferred status, then they get an approval from SBA within 24 hours. There is another way they can process it, which is called general participation. And that's where we do review some of the specifics of the loan file. And currently that would add about 3 to 5 days on average to the processing time. But it's important, and all these lenders mentioned it, it's important that you communicate with your lender because your lender is going to know how it's going to be processed and how long it should take. And as long as you communicate with that lender, then there should be no kind of gap in the expectations that you have, whether you use an SBA loan or a lender's portfolio products or any other product.
Thanks, Craig. And the counselors you heard from earlier, Karen and Kevin and George, with the SBDC, as Paula mentioned, we're working with clients every day, and we're trying to give them this guidance as well. And the piece I think that is most challenging after they get all the paperwork is, okay, if I'm going to meet with a lender, what are they going to ask me? How can I prepare? So let's start with Gerald. Let's start with Gerald for this.
So typically one of the first questions, I get asked in the lending process, or that I ask is, have you worked with the SBDC for one? The resources the SBDC provides a business is beyond compare, in my opinion, for setting expectations on how to talk to us. But I mean, I'm a huge fan. It's your money. It should be working for you. So ask us what you want to ask. Like, there's nothing wrong with going like, is this the kind of loan that you want to do? Lenders have appetites. Are we in the market that you're trying to, buy into? Do we work with? Some of the questions were about intellectual property. Some of the questions were about private practice. Like, do these lenders have experience in that? And there's nothing wrong with asking that. So, treat it like it's an interview. Write your questions down. Make sure that you ask them to us. So that way, you can find out if we're a good fit for you. We're going to ask you a lot of questions based on what we have to. We're going to ask you questions that we want to know. But just go into it expecting an open discussion. The questions you should ask us, I wish there was just an easy answer to that, but there's not. It's what's important to you. Make sure that it's important to us. And if they line up, it's going to be a pretty good process. So.
Thanks, Gerald. Uriel will go next to you, and then Caroline.
Thank you. So lenders, what we recommend clients is to have an understanding, or just in general for small business owners, is to have an understanding of their credit. Borrowers and business owners, individuals can download a copy of their credit report online through one of the 3 credit bureaus and find out what their FICO score is. And based on that, I know Craig had showed a nice metric of what is considered excellent credit, good credit, fair credit, poor credit. And so kind of match that up. And then when you're working with your lenders, ask them, what are your minimum requirements? Some might tell you, hey, it's 720 or it's 680. And so that kind of gives you a better understanding of where you stand with matching with that lender for your request. Now, there are some lenders, Lendistry is one of them, where we don't do hard inquiries on your FICO score. We do a soft pull. And so that may be helpful when it comes to applying because it doesn't impact your credit score. The types of questions that you should have, I mentioned some earlier, in addition to what is your FICO score requirements, would be your time in business. What are your time in business requirements? What are your income requirements? Craig also mentioned the cash flow debt service coverage requirements. So some lenders might want to see that your business is profitable. There was a number that in general 1.25 that was on the presentation. Simply what that means is that lenders want to see that your business is sorry, just saw something on the image there. Lenders want to see something that lenders want to see that your business is slightly profitable by at least 0.25% to show that you can meet your obligations. So, thank you.
One of my first questions when I meet with businesses, and you heard it, discussed in the beginning of the presentation, is how much money do you need and how are you going to use the money? And it's not uncommon for businesses to not have answers to those. Ideally, we want to make a loan to help you, not just giving out money that you're going to find uses for, right? Sometimes I get that, right? Someone's just trying to fill the bucket to the entire loan amount that we're able to lend. So ideally, you should know that going into the meeting, how you're going to use those funds, how they're going to help your business grow or solve a problem that you currently have. You should know your financial numbers ahead of time. Are you profitable? What was your revenue? What's your current revenue? How much did you make in previous years? Those are going to be some of the questions we're asking. So if you have answers to those, that's going to help move the meeting forward. Additionally, we are going to ask a lot of questions, and there's no wrong answer to any question. I know when we're talking about finances, it can be a little uncomfortable. Not everyone loves to talk about that, and it also can be very personal. But know that we're asking these questions to figure out what we have to work with and how to structure a product best for you. So, there's no wrong answer. Just let us know what's going on, and we can help you either through a product that we have, or a lot of us work together in the community, and so we can connect you with someone else who may be a better fit.
Okay, thank you. Thank you very much, Caroline. John, anything you want to add?
I would agree with what Caroline said there, that we'll ask lots of questions. I was meeting with a customer earlier or last week, and they said, everything about me and your customer. So yeah, that's just the way it goes. But it's just so important as you approach a lender that you're confident, you understand what the ask is for, you have a purpose, you know where the funds are going to be used, how they'll be used, and how they're going to benefit your business. And I think that's really key, that how is that going to benefit your business to grow, who your client base is, who you're serving, who your competitors are. All those things are just really important to understand, and come prepared that you understand and have the financial information in a clear format that can be easily digestible.
Thank you, John. Craig, anything you need to add?
I would just support what they said. I mean, if you called up, I would probably ask you all about where your position is in those 5 C's. It's just that simple, which they've all mentioned it. So those are the things that you really need to know about yourself as you go in to speak with a lender, is how do I fit in those 5 C's, right? That's what I would ask.
Thank you, Craig. So let's say all goes great and the more than 100 participants on this webinar get to this point. They put everything together. They've got their paperwork. They've got their business plan. What do business owners, what does the borrower need to know about looking at their loan contract? And part of the reason why we ask this is, yes, we want to hear from you, but the other caveat to that is that our small business analysts for the SBDC do not give tax or legal advice. So sometimes we are asked or provided loan documents, but we really don't want to be in that position. So tell us what our borrowers should be looking for? And then are there annual reviews or obligations? And for this last question, let's start with John.
All right. So I think it's just important when you're reviewing loan documentation that you take the opportunity to understand and walk through it with your lender, and so you're on the same page. You know what you've agreed to do. You know if you've agreed to provide financial statements to that lender annually, that it's very clear that's what the requirement is before you sign that document. So you're not being surprised 12 months later saying, "Hey, send me your tax returns and your financial statement." You're wondering, why do you want this? And so as part of SBA loans, it's generally required to provide your tax returns annually. So that's something to be prepared for. As far as what happens after loan approval, I think it's key that as everybody's starting to get excited, the loan's been approved, you're getting ready to move forward to closing. And so there's going to be things that are going to be needed. There's going to be additional questions, whether associated with your collateral or whatever that might be securing the loan. And it's going to be a little bit of a process generally, unless it's a straightforward unsecured loan. Those will close quickly. Other ones will take a little bit of time. So just be aware that's going to take some time to get through that piece of the puzzle. And the annual reviews or obligations, I would say, would be generally on smaller size loans, maybe some annual financial reporting you'll send in. As loan sizes get bigger, you might be required to meet certain covenants, certain debt service coverage covenants that will be calculated with the collection of your annual financials. And so if you're talking about a larger loan amount, just be prepared for that and be prepared to be able to do that on an annual basis.
Thank you, John. And you all have provided great information, and we're reaching the end of the time that we have available for the panel discussion. So I would ask that Caroline and Gerald and Uriel, if you have something else to add, will you keep your remarks to 30 or 45 seconds?
Thank you. Just to add, this is Uriel with Lendistry. I would say the first thing to look at is if you agree to no prepayment penalties, make sure that those terms are there listed in your loan contract. Things like the rate, make sure that it is the rate that you had agreed upon, the term, the length of the loan, the amount. So those are all the things I would mainly look at. And if there are some requirements like obligations that you have to do, for example, provide insurance, is to make sure that you're following those, because they can come back and either ask you to provide the information, or depending on what the contract says, you might be required to do additional steps in reviewing. For example, if it's a line of credit, it might not get renewed again. So just keep that in mind.
Thanks, Uriel. Yes, go ahead.
I'd like to add quickly. The financial products are kind of changing by the day, and we're seeing a lot more in the market that, looks similar to something that a traditional loan, but it acts a little bit differently. So it's really important to read through your documents and understand what they mean. Ask questions and don't sign until you're comfortable, and understand how whatever financing you are taking on works for you.
Thank you. Gerald, anything additional?
Yeah, the last thing I'd put in there, I threw into the comments, but yeah, schedule yourself time to review all this stuff. Don't rush your closing. That's how all the stuff gets missed and forgotten. You're spending a lot of money. Make sure you feel the weight of that. Take the time to review it. And that way you're not surprised. So.
Thank you. And Craig, anything you want to add to that?
No, I think they did a great job. I think the one thing is to make sure that you understand, if you're entering into a variable contract, that you understand that it's variable. You know what the index is that you're using. You know what the margins are. You know when it's going to change. You know if there are ceilings or floors on that. And if that type of language that I just gave you is something you're not familiar with, then like the other lenders said, you're going to have to take a step back and make sure that you understand it. Because as you have a long-term contract of lending, you're going to need to be able to maneuver your business to be able to meet those obligations. And a lot of times when borrowers call up, they don't really quite understand what a variable rate is, why, if you've been part of the last couple of years, you've noticed those payments can increase. as those variable rates change, and it's important that the business can adapt to that and understands how that's going to work.
Thank you, Craig. And thank you again to all of our panelists. Great questions, great responses. And I know our participants learned a lot about what the process is and what the next steps are. So I'm going to turn it back over to Paula to wrap things up.
All right, thank you, Nancy, and thank you to everyone on our lender panel today. I mean, looking at the clock, it's 11:20, and it's gone by very quickly. We've covered a lot of information, but now it's kind of like, that's a lot of information. What do I do next? So as we've been moving through our presentation today, we've talked about 8 different questions. So think about these 8 different questions as kind of your checklist of what do I do next? You can kind of follow each of these questions, getting answers along the way to help you to that funding journey. And, again, SBDC advisors are here to guide you. We do this, like Nancy said, on a day-to-day basis. So please, feel free to check out our services, and let me share the resources to help you. So, of course, if you are interested in Small Business Development Center advising, SBDC advising, we've got the link there. You go to our website, you find the location based on where you're at and what center is closest to you. Funding readiness, business plan development, financial education, you see them listed there, but many more. But in addition to what Karen and Kevin had shared with you back in the readiness section, we have tools available for our small business clients that can help you along the way and at no cost to you. So we have Live Plan, where you can develop your business plan on live, both the narrative section, pitches, but that financial piece too, which can be not always easy to do if you're not that numbers person. Profit Sense is another financial tool that can inform that business planning development. And Vertical IQ and IBIS World are both platforms that provide industry reports. So when you're preparing that business plan, around those sections of market analysis, competitive analysis, and all those different items, even some financials, those tools will provide information, valuable information to you at no cost as you're working with your advisor. Esmeralda has been, I believe, putting in contact information for our lender panelists. Lender panelists, if you would like to also go ahead and put in chat your contact information, feel free to do that. We will be sharing, well, before I say that, let's talk about SBA resources. So we had Brian and Craig on our call today. And again, thank you to both of you for being here today. Brian just touched very briefly on SBA loans. So if you want to take a deeper dive on that particular topic, every first Wednesday of the month, they do have an SBA loan clinic webinar. And it is free to attend. It's online. We've put the link there to the SBA district office where you can find that information. You'll also find there, Craig had mentioned the lender match program. You'll find all that information on their particular site. And also on the SBA.gov site, another really great resource for many different topics, not just funding. But I did find they have this Ascent program. And this Ascent program, it's an online program where you can go and learn more about many different topics related to growing and building your business. But the Journey 5 deals specific to access to capital. So if you're someone who likes to go in there, dig in there and read and at a bit more depth about this whole funding process for your business, I would encourage you to check out that particular program. Some really good foundational information, a couple simple tools to help you start to, develop that funding plan going forward. Now we will be sharing with you the slides today. So I think we're ready to close out. I want to thank all of you for participating in the program today, but we will be sharing the information, the slides, in a follow-up email you will receive, which includes the survey for our session today. So please, I encourage you to go to or answer that survey, provide us some feedback, and we'll have some additional resources in that email.